Good afternoon, folks. Happy Friday, and welcome to this week's version of Weekly Commentary. April was a reminder that markets don't wait for clarity, they front-run it. The S&P 500 gained over 10% and the Nasdaq nearly 16%, marking the strongest performance since the 2020 pandemic-driven rebound. This despite a renewed oil shock and continued tariff pressure that, according to consensus, should be derailing risk assets. It isn't. The prevailing macro narrative seems once again to be out of sync with reality. Now, oil at $110 and gasoline up 50% since the conflict began sounds alarming until you put it in context. We've seen this movie before. In 2022, similar price levels contributed to near universal recession calls that never materialized. Today, the Fuel Affordability Index remains within historical norms and is actually more favorable than during the 2022 period. So far, the consumer is absorbing the shock. High energy costs only become a true macro problem when it persists. That's the bet the bearish camp is making, and I think it's a weak one. Iran's position is weakening, not strengthening. Their only real leverage is sustained oil pressure that global economies would quickly find sustainable. But absent a prolonged move materially above current oil price levels, that leverage erodes quickly. The clock is ticking and working against Iran at this point. And the markets understand this. More importantly, markets are correctly focusing on what actually matters right now, and that's earnings. And earnings are not just holding up, they're accelerating. First quarter guidance have mostly reset earnings expectations higher, significantly higher actually. The consensus S&P 500 earnings growth for 2026 has moved from roughly 14% at the start of the year to nearly 23% as of today. It's a significant shift in expectations. Valuation concerns at the beginning of the year appear to be increasingly misplaced. If earnings compound at this rate, multiples will compress even in a rising market. In other words, prices can continue higher while valuations decline. There are also additional tailwinds bubbling beneath the surface: tariff refunds, fiscal support from the big beautiful bill, and, importantly, the continued scaling of AI-driven productivity, which are all likely to contribute to stronger nominal growth in the back half of the year. Now, if geopolitical pressures ease even modestly, the upside bias increases meaningfully. The AI trade is back, and deservedly so. CapEx is accelerating, not rolling over, up 10.4% in capital investments across multiple industries in the first quarter. This is not speculative excess, it's strategic investment, and the market is mostly rewarding companies that are spending aggressively because the payoff is becoming more tangible. That said, there are pockets of softness in the economy. The PMI print earlier this week at 49.2 is a clear signal that parts of the economy are contracting. It should not be ignored, but it also should not be extrapolated. Markets are discounting a slowdown in the economy, not a collapse. Inflation continues to remain the key concern, and recent data came in firm enough to keep the Fed on hold for the foreseeable future. Rate cuts are effectively off the table for now, and now there exists a marginal risk toward tightening, though I think that possibility remains a low probability. The bigger story out of the Fed, however, wasn't policy, it was personal. Chairman Powell's decision to remain on the Board of Governors is unprecedented in modern history, and frankly, I think it's hard to justify. The stated rationale of preserving norms and independence rings hollow. Staying on actually breaks 80 years of precedent, not preserves it, and his influence as one of 11 votes will be limited at best, so what's the point? At a minimum, it complicates what should be a clean transition. With Kevin Warsh expected to take the Fed chair on May 15th, the Fed had an opportunity to fully reset. Now we're likely to see a partial transition with lingering influence from the Powell regime. That's not ideal. Certainly, from my perspective, not welcome. Warsh, however, is already signaling a different approach, one that I like, and that is less reliance on the ridiculous dot plot, fewer drawn-out press conferences, and a move away from constant public forward guidance. That alone would be a meaningful improvement, because markets do function better when the Fed talks less, not more. Now, on the micro side, earnings continue to confirm economic resilience. Recent reports this week from the Magnificent Seven, 5 of the 7, were universally strong. The initial negative reactions, particularly in Meta, are exactly what you would see in a healthy market. Strength is being sold into, not chased. That's positioning, not any kind of deterioration. So concerns around AI CapEx do remain the primary pushback, but so far those concerns are not supported by the results. Spending is high because the returns on that spending is increasingly visible. Frankly, it's beginning to get exciting regarding the potential future positive impact on GDP growth that we're going to see from AI. In summary, the market is climbing a wall of worry that is, in many cases, overstated. Energy, inflation, geopolitics, and Fed uncertainty, they're all valid risks, but none currently rise to the level of breaking this secular bull market. Positioning remains cautious relative to the data, and that gap creates opportunity. And we will continue to remain focused on, frankly, the same variables: oil, inflation, geopolitical developments, and the evolving Fed posture. But until those inputs deteriorate materially from here, the path of least resistance going forward for both the economy and the markets remain higher. We will, as always, be watching all of this very carefully, and we'll do our best to keep you up to date each week. Sometimes it's not every week. I was traveling last week, unable to offer the commentary on Friday, but we do hope to do it at least 3 times a month, and we'll keep you apprised as often as we can. Have a great weekend.